member also. Mr. Becker, SVB experienced astounding growth from 2019 to 2021. Assets grew 198%, 6 times the median growth for comparable banks. When SVB was growing fast, did it ever occur to you that new deposits funding that rapid growth could leave the bank as quickly as they came in?
Senator, when the growth was occurring, I think it's important to note that the growth was from existing clients. So yes, we added new clients, but it was mainly our existing clients were raising more substantial amounts of money. And so we built several things. One is we added to our liquidity, making sure that we had borrowing capacity so that we could support an outflow of deposits which would occur. But again, I think it's important to note that was mainly from existing clients.
By every measure, that kind of growth may sound good to Wall Street, but for most bank managers, it means more risk factors to keep track of. When your bank failed, it had 31 unresolved matters requiring attention, the Fed's term, 31 huge red flags identified by regulators. I think it's safe to say rapid growth was not because Silicon Valley Bank was 6 times better than other banks. Mr. Howell, once you started new business lines, it was important to show investors that Signature Bank could still be profitable. Is that right?
Profitability was certainly something that we always looked at.
It seems like big losses and a struggling stock price motivated management to jumpstart profits and boost the stock price. In doing so, you just didn't seem to care about increasing obvious risks. Mr. Becker, your version of events blames SVB's failure on too many interest rate hikes, a social media-driven bank run, the closure of the much smaller Silvergate Bank, and the regulators for being slow to highlight its long-standing problems. It sounds a lot like the dog ate my homework. Your explanations ignore that your bank was without a chief compliant officer for the better part of a year. I don't think that was in your testimony. While you watched deposits leave and losses on long-term investment securities began to pile up, your version on that leaves out that you only tried to fix things when you were told that SVB was going to be downgraded. Is there any other explanation that you just wouldn't make any effort to fix the growing problems because it would have cut into earnings?
Chair Brown, we took risk management seriously, and we both were proactive in risk management and also were responsive to the regulatory feedback. And I think in the GAO report, it outlined the responsiveness that we had. And I think if you have an opportunity to talk to regulators that were directly involved, I think they would share that point of view. Regarding the chief risk officer, if I may add to that answer, we decided, the board and I, along with feedback from the regulators, that we were going to look for even more experienced CRO. And in my experience, it takes 6 to 9 months to find the best person for a role. We did 2 things to make sure that we had coverage while we were looking for a chief risk officer. First, we created an office of the CRO with the leadership team reporting to me and reporting to the chair of our risk committee. And secondly, we kept our chief risk officer on board as a consultant through October 1 to make sure there were no gaps during that period of time.
Mr. Shea, one of Signature Bank's fatal flaws was a concentrated depositor base that made it susceptible to a bank run. FDIC and New York banking regulators identified this as a problem. Signature Bank management assured them the bank's relationships and dedicated customer service would make customers less likely to flee. In the end, you bet on the hope that customers really valued that relationship, ignoring common sense risk management. The bank ended up with an extraordinary level of client concentration. The numbers, frankly, are hard to believe. 60 clients held 40% of total deposits, 4 depositors accounting for 14% of total deposits. Did you need that kind of concentration to make quick profits, Mr. Shea?
The bank took steps to offset and ameliorate the concentration of uninsured depositors. The bank set aside an internal allocation of liquidity in order to offset or in order to provide an internal collateral measure of maintaining high quality assets against uninsured deposits. In addition, the bank endeavored to diversify its deposit portfolio mix and maintain liquidity availability to offset those higher concentrations of assets.
Thank you, Senator Scott.
Thank you, Mr. Chairman.